Principles of Accounting 2, Chapter 6. In Chapter 6, we're going to look at variable costing, absorption costing, and segment or divisional analysis. The main underlying assumptions for these concepts are that we're going to use actual costing rather than normal costing. So remember, the difference between actual and normal is that normal uses a predetermined overhead rate, where actual uses the actual cost. We're going to use the actual number of units produced as our allocation base for assigning actual fixed manufacturing overhead costs to products. And we're always going to assume that our costs remain constant. When we're looking at the difference between variable and absorption costing is what our normal has been for this textbook. So chapters 1 through 5, we've been looking at absorption costing. The absorption costing, all costs, material, labor, and overhead end up as product costs, and selling and administrative expenses are period costs. Under variable costing, direct materials, labor, and variable manufacturing overhead are product costs, but fixed manufacturing overhead becomes a period cost. Looking at absorption costing versus variable costing is done for analysis, and as we go through the analysis, we'll talk about the importance of this analysis and why we look at it in different ways. So we have this example with Harvey Company, and Harvey Company makes a single product. We have our variable cost per unit and our fixed cost per year. When we're trying to determine what our unit product cost is, we know under absorption costing that we would include all product costs, direct material, direct labor, and variable and fixed overhead. So under absorption costing, our unit product cost is $16 per unit. Under variable costing, we don't include the fixed manufacturing overhead, which makes our unit cost $10 per unit. Now we're going to look at an example where we sell 20,000 units during the year at a price of $30 each. We have no beginning inventory in this example. You can see here that we made 25,000 units. So our number of units produced annually is 25,000. In this example, we've sold 20,000 of those units, so we have 5,000 units sitting in finished goods inventory. We can see under variable costing that our operating income is $90,000. However, under absorption costing, our net income is $120,000. The reason that the income goes up is because of that fixed manufacturing overhead cost. So we've included 100% of the fixed manufacturing overhead as a period cost here in the variable costing. But in absorption costing, part of that manufacturing overhead is deferred in our inventory. So this $30,000 value is sitting in our finished goods inventory in those 5,000 units of inventory. That then makes our operating income $120,000. When we compare these two, the total value of inventory is essentially the same. When we look at the total cost of our variable manufacturing expenses and our fixed manufacturing expenses, it adds up to the same amount. What variable costing versus absorption costing does is how much of that overhead is sitting in our ending inventory versus how much was expensed out during the period. As I said earlier, this is important analysis to try to determine what our actual monthly expenses are compared to our inventory expenses. Another reason that it is important is for manager evaluation. Because you can see if we produce more items than we sell, we boost the income under absorption costing by transferring that fixed overhead cost into our finished goods inventory. So it sits in our finished goods inventory. We can then look at what would that income have been under variable costing. If we look at it under both ways and compare that, we can create incentive programs based on income measures that don't incentivize managers to stock inventory. So under the absorption costing, if a manager is trying to boost income every period, they can simply do that by overproducing inventory. That is not a practice we want our managers to have. And so if we evaluate them based on variable costing, they won't use that inventory boost to boost their net income. So we can see the reconciling between the variable costing net operating income of 90,000 and the absorption costing of 120,000 is that 30,000 in fixed manufacturing overhead costs that are sitting in our finished goods inventory. In the example 2, we have 25,000 units produced, 30,000 units sold, and 5,000 of those units were in beginning inventory. So we started the month with inventory, we sold 25,000, or we produced 25,000, and then we sold 30,000. So how does that break down in the variable versus costing? So under variable costing, selling 30,000 units, our net operating income is $650,000. Under absorption costing, our net operating income is $230,000. Well, why does it drop when we sell more than we produce? So we can look at the cost of goods sold. So our variable cost of goods sold is $300,000. And treating our fixed manufacturing overhead as an expense means we just have the 150,000. Where if we have the absorption, we have the 30,000 that was in, we have the $300,000 in variable expenses, the $30,000 that was sitting in our ending inventory, and the 150,000 from this period. So our cost of goods sold is much higher when we sell more than we produce. So we can look at the reconciliation of that. Our variable costing net operating income versus the absorption costing net operating income. This chart summarizes this. So if the number of units we produce matches the number of units we sell in a period, the difference between, there is zero difference between the absorption income and the variable costing income. They're exactly the same. If we produce more units than we sell, absorption income is higher than variable costing income. And if we sell less, if the items produced are less than the items sold, then the inventory decreases and the absorption is greater than variable. As I said, most of the reasoning behind this analysis is to look at how well managers are performing in their inventory management and compared to net income, usually done for manager bonuses. So our variable costing looks at the variable and fixed, so we can use this for CVP analysis. We also know that the absorption costing assigns fixed manufacturing overhead costs to our units produced, so then a portion of that fixed manufacturing overhead resides in inventory when units remain unsold. So the potential result is having positive operating income when the number of units sold is actually less than the break-even point. So we look at variable costing with CVP analysis. Why are these differences in net operating income? So variable costing income is only affected by the changes in unit sales. When sales go up, net operating income goes up and vice versa. Well, absorption costing income is influenced by changes in unit sales and units of production. We can increase the net operating income by simply producing more units than we sell. Variable costing also helps us make decisions because we emphasize the impact of total fixed costs on profits. And absorption costing gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced, but it's not. So using only absorption costing can lead us to making inappropriate pricing decisions, inappropriate CVP analysis, inappropriate discontinuation decisions. This is one of the reasons why we tend to treat variable cost as the per unit cost when we're doing analysis and fixed cost as a total fixed cost instead of as a per unit fixed cost, because our total costs are the same every period, regardless of how many units we make